Awesome. Okay, so today we have a very exciting episode here. So everybody, welcome back. This is just yet another exciting episode of Investing Passively in US Multifamily Show. I'm your host, Jefferson Ortiz, and I'm joined by my co-host, Jonathan Ortiz. What we do is we partner up with passive investors and help them acquire large multifamily properties in the Sunbelt region in the Midwest. So today we have an honor to have a true multifamily investing powerhouse with us, Charles Seaman.
That's right, Jeff. Charles is a managing partner of Cashflow Champs, and they're based out of Charlotte, North Carolina, with an impressive portfolio of 8 multifamily properties totaling 863 units, and having gone full cycle on 2 multifamily properties. Charles' track record speaks volume. Welcome to the show, Charles, and pleasure to have you.
John and Jeff, thanks for having me. It's a blast to be here today.
Awesome. Okay, Charles. So Charles, without further ado, we're thrilled again to have you with us today. Before we dive into your multifamily investing journey, could you share a little background on your journey, what led you to becoming a multifamily apartment syndicator? Just give us a little background on a little bit about yourself and your journey here.
All right, so my journey was probably a little bit different than some of the others that get into the space. I can't say that I ever really sought out to dive into multifamily and commercial real estate, but it was more the way I like to tell the story. I was 20 years old and I was young, dumb, and broke, and I needed a job. And I wound up working for a guy who was a successful entrepreneur and successful commercial real estate investor, and I was fortunate to work in that position for 14 years and to learn a lot from a guy who was very successful, all while helping him run his different businesses and properties. And of the different industries that I had exposure to, the one that really gravitated to me was the commercial real estate one. And around 2014 or 15, I'd been there nearly a decade, and I wanted to start looking at doing some things on my own. And initially I dabbled into single family because while I really wanted to be in commercial real estate, I knew that I didn't have the financial wherewithal to go out there and take those deals down by myself. So I started dabbling in single family and wholesaling, and went to a couple of events. I hired a mentor, but after a few months I realized a few things. One, I didn't really like single family, and 2, I wasn't good at it. And it's not to say that I couldn't have developed the skills needed to be good at it, but my heart wasn't set in it. I was looking at it and saying, boy, I'm doing these big deals at work, these are exciting, and now I'm going out and I'm starting with smaller deals. And the reality of it is, it's not a knock on single family, because I have a lot of friends that do very well on single family, but it just wasn't what I wanted. So then I kind of took a step back and I did some soul searching, and fast forward about a year to late 2016, and that was the first time I discovered syndication. So at that point I went to some different events and I started learning about it, and I said, okay, this sounds pretty good. It'll allow me to use the skills I've already developed and to do the deals I want to do and to use other people's money. So it sounded like a good scenario, and I said, okay, well, this is something I need to learn more about. So in 2017 and 18, I had taken some courses and I dabbled into it. And the good thing was, what I found is the information that I knew from my job was good information that translated over into this. Sometimes if you're doing things one way, you don't really know if it's the right way, because it's the only way you know. So as I was taking different courses, I realized, okay, good. Everything I know and I'm doing at my role in my job actually lines up with this. That works out well. The one side that was new to me was the capital raise side, because the guy that I worked for used his own funds, so he didn't need to go out and raise capital. But I knew that for me personally to do these deals, I would have to figure out how you go out there and raise capital. So from mid-2017 on, I started dabbling into, making connections, looking for deals, and doing things that would advance me to getting deals done. And it took a little bit over 2 years, but I finally closed my first deal in September of 2019. And then from there, the goal was just to figure out how to do more deals and how to build more momentum.
Wow. Okay.
That's great. That's a great start there. Charles, your success in multifamily has been obviously remarkable. I wanted to pick your brain and get your thoughts on what sets this asset class apart compared to any other asset class out there, such as stocks or bonds or any other sort of investment there.
Sure. So there's two things I would say that really set it apart. The first is stability. You know, I never think of multifamily as the sexiest asset class. It's not a bad asset class, but not the sexiest, but it's stable. And I think as people found out during the lockdown months of the pandemic, when office buildings and retail strips and things like that weren't performing so well, multifamily was still fairly consistent. And, you know, it may not always give you the best returns, but it usually gives you good returns. And it gives you stability in an asset that historically tends to perform well, even in times of economic turmoil. The second thing I think of is tax benefits. And a lot of people look at just the returns that they see on a projection when they're thinking about investing in a deal. I would actually say sometimes the greatest benefits are the returns that you don't see on the projections. And it's how it impacts everybody below the line. Because keep in mind, you know, regardless of how much income you make, what it's really about is how much you're keeping. So you can make a lot of income, but if you're paying a lot out in taxes, then ultimately the strategy didn't really benefit you.
I love that you said it's how much you get to keep. That's a great point. And you know what, you're absolutely right about the stability of multifamily in some downturn economic times. As me and Jeff were actually doing a webinar last week on how we're still finding deals in today's market, and single family homes actually fell down 27% during the 2008 crash, and multifamily only fell down 2.7%. So huge difference there in stability. So absolutely right. Jeff, any thoughts on that?
Yeah, no, I agree with you, and that's part of the reason why we love multifamily. Now, Charles, give the audience a little bit of background. You said you closed on your first deal about 2 years after, like kind of learning syndication or learning multifamily. Tell us a little bit about that first deal.
Yeah, so the first deal was a 92-unit multifamily deal. And, you know, some people may look at it and say, wow, that's a really big first deal. And then other people may look at it and say, well, it's small. It can go either way. It's all in perspective, right? So my thought initially when I first started is I wanted to be focusing on properties that were 100 units and up. And the reason I wanted to do that is because those properties are generally large enough where you can get full-time staff. And full-time staff makes it a lot easier to manage a property than it is to manage it with the offsite management, because there's a lot of things that, you know, are just tough to control when you don't have a physical presence at the property. So what I found after looking for deals for about 2 years is that a lot of times I wasn't competitive on those larger deals starting out. And, you know, like some of them I come close on, but close only counts in horseshoes. I didn't win any of them. And there were a few that we were in the running, but either we didn't have the track record for, or there were just, you know, other reasons why we weren't selected. So this deal was actually brought to us by our KP and sponsor on it. And, you know, ironically, I've been spending a lot of time looking for deals, come close on a few, but we hadn't won any. And my partners and I at the time, we thought about it and said, well, he's bringing us this deal. It's in a market that he knows really well, the Atlanta market, because he lived there. Most of his deals were in that market. And he knows the market really well. He's actually owned other properties in the same sub-market. He even looked at buying this very property 3 years ago, but he wasn't successful on it at that time. So the reason he thought of us is because for the last year prior to that, we were bringing him deals on a regular basis. So, and we were putting offers in and like we were bringing him good stuff, you know. So keep in mind, guys, one thing you want to do, especially when you're dealing with sponsors or potential partners, make sure you vet these deals and that you do your homework on them. If you send them garbage, the result you're going to get is not going to be a favorable one. So he could see we were serious and that we were doing the homework on the front end, and we just hadn't gotten one. So that's why he thought of us, and he said, well, do you guys want this deal? And for him, he was doing 200 and 300 and 400 unit deals at that point, so he didn't really have any interest in a 92 unit deal. And he offered to sponsor it, which he did. He offered to use his management company to management, which we graciously accepted, and they did a great job. And overall, he was very instrumental in bringing that deal to us and helping us get the first one across the finish line. So initially, when I first got the deal from him, I underwrote it. And like many people starting out, you know, you probably tend to be too conservative on your underwriting, which is good in some ways because you don't want to get into bad deals. But the problem is sometimes it also keeps you out of good deals. So, I thought about it. After I underwrote it, it came out, not as favorable when I underwrote it. But I said, well, he has 2,500 units. I have none. He knows the Atlanta market and owns his own property management company. I don't. And he's had some success the last few years, and I'm still looking for my first one. So after thinking about it, I said, well, maybe we should follow his lead. He's obviously doing something right, and it turns out that was a good decision.
Awesome. Yeah, absolutely. And I think some key takeaways that I'm writing notes as we speak. Some of the key takeaways that I took is that obviously multifamily is a team sport. Would you agree with that?
I'm sorry, multifamily is what?
Is a team sport.
Oh yeah, absolutely.
And
Charles,
go ahead, Doug.
No, I wanted to ask you, Charles, what are some of the major lessons that you've gained from your previous multifamily deals, especially the ones that went full cycle?
So, some of the best lessons I've gained have actually probably been in the last year and a half or two.
Mm-hmm.
And for anybody who's unfamiliar with it, there's been a lot of transition in market cycles over the last year and a half or two. We've seen increases in interest rates. We've seen a lot of buyers, sit on the sidelines, and there's definitely been a lot of lessons. So the lessons you learn aren't so much from the deals that go well, it's from the deals that don't go so well. And all the deals that I'm in with long-term fixed rate debt have done pretty well. The ones that I'm in with floating rate debt, probably not as well. Now, granted, if you bought those properties with floating rate debt in 2015 or 16, and you held them 4 or 5 years, you'd probably still do okay because rates were going down at that point, so you had some momentum working with you versus against it. 3 things I would say that I've learned that are really important, and I'd recommend for anybody starting out. The first thing is market timing is absolutely important. So if you're buying a property and you're going to hold it for 30 years, timing is not so important because you have a very long timeline to make up any mistakes that you may make on the front end. Not that you want to make mistakes, but you have a longer timeline, so it's more forgiving. With syndication, you're generally targeting a shorter timeline. Most syndications are probably 3 to 5 years, 7 to 10 on the long side, but mostly 3 to 5. Mm-hmm. And because of that, if you buy at the top of the cycle, riding the downward movement is going to make it very, very tough for you to recover from. So my lesson there for everybody is, 1, make sure you know where you are in the market cycle, and make sure that you're buying heavier earlier in the cycle, and you're buying less, and maybe even at some point coming to a stop as the market cycle's coming near an end. And you're probably asking, how do you know when the cycle's coming near an end? Well, let me give one key indicator that I realized in my own dealings was just a very important one. So what makes these deals work or not work more than anything else is debt. I used to think location was the most important word in real estate. And maybe in certain asset classes it is, but I think in the last year and a half, what's become really apparent is that debt is easily the most important word in multifamily. So it was September 2021 when conventional financing, specifically Fannie Mae and Freddie Mac loans, stopped being available at reasonable rates of leverage based on historical norms. Mm-hmm. Now, when you start seeing that in the market, it's probably a good idea to put the brakes on it. So probably not what a lot of people want to hear when you're starting out, because you want to be ambitious, you want to be starting out, you want to be aggressive, but you also want to be smart. And that's very important so you don't get into deals that you later regret. The second takeaway I would tell you is always have more cash reserves than you think you need. And I'm not talking about just in the deal, I mean even personally, because the thing is, sometimes you may need cash reserves, one for yourself as you're building your business, if you're doing this full time, but 2, even for the deals, there's going to be times when things don't go according to plan, and you're going to need to have more cash on hand so you can help to right any wrongs that may have occurred in that transaction. So those would be probably my big takeaways that I would offer anybody on that.
Wow, beautiful. Those are golden nuggets for sure. I definitely wrote some notes down.
That was that was some high level intake there, and you're absolutely right. It's timing of the market and your business plan have to be intact. They have to be intact, absolutely. Charles, you're known as a very well and amazing underwriter. Can you walk us through your underwriting process and the key factors you consider when evaluating potential investments?
Yeah, totally. So the biggest things I look at, and with any deal, you want to know if your numbers pan out. And one thing I've wanted after doing this for a couple of years, when you start out, most people tend to be very conservative, which again, it's good that it keeps you out of bad deals, but sometimes it's so conservative that it keeps you out of good ones. So you want to start tweaking your underwriting and always learning from it, and realizing that as you make progress and you start developing a greater skill set and greater knowledge base of what things you might be able to tweak that can allow you to be more competitive on deals, but not be overly aggressive where it's unrealistic. So with any deal, the biggest things you're going to have first is definitely purchase price, but you're also going to look at where things are in terms of market conditions. So right now we're in a buyer's market, and a few months from now it'll probably be a stronger buyer's market. So what'll happen is the buyers are going to have full control at some point over what you can really do to name a price. 2 years ago, it was one of the strongest sellers markets in history. So what that meant is a lot of buyers were paying premium prices because that's what they were needing to do to win deals. So I'm sure a lot of those buyers will wind up regretting those decisions eventually. But so the thing is, you want to figure out what the most you can pay is that's going to allow you to achieve the returns. But depending on the market cycles, there's not always a lot of room for negotiation. Although, good news is for everybody listening now, you'll probably see some great opportunity for negotiation in the coming months and years. But next thing is terminal cap rate. So that's always a big one, and unfortunately none of us have a crystal ball, so you can't guess exactly where it's going to be. One of the risks right now, in the last couple of months and even the next couple of months, is a lot of people are under the impression that cap rates are decompressing. What we don't know is where they're going to stop. There are some people who think where they are now is as high as they're going to go, and eventually we'll start seeing some compression. There's others who think that maybe things will get a little bit worse, which means you might need a little bit higher terminal cap rate. And there's others who think that the bottom is going to fall out and we're going to have a terrible recession or depression. And in that case, you might need very high terminal cap rates. So what you want to do is speak to enough people who are familiar with the markets you're investing in and hear their perspectives. You want to look at the data that's available from things like CoStar and other paid services like that. But you want to be able to form a confident opinion of where you see the market going, realizing that nobody's going to be 100% right on that because none of us have a crystal ball, so we can't predict the future. But use a reasonable level of conservativeness based on your knowledge of the market. Another thing, yeah.
Okay, so sorry. No, I just wanted to ask you, kind of while you're at that, why do you think cap rate is so important in the multifamily space for people that may not be familiar?
or is it even? I mean, it's completely important, but a lot of people tend to take a cap rates completely different than other people. So from an underwriting perspective, Charles, how do you look at them, and how do you kind of evaluate them in a sense?
Yeah, totally. So I probably use cap rates a little bit different than some other people do. So there's definitely people that use cap rate as a return metric. To me, I've never really looked at cap rate as a return metric. And the reason that I do that is because cap rate's only a return metric if you're buying the property all cash. I don't know about you guys or the listeners, but it's rare that I'm buying properties this size all cash. So there's usually debt involved. So the way I look at cap rate is more as a barometer. And what I like to see is, okay, what am I paying in relation to where the market is? So if I'm buying a C-class asset in a market and I'm paying a 4.5 cap at all the other C assets are selling at 6, then maybe I'm paying too much and I need to rethink strategy on there. Conversely, if we go the other way and all the C assets in the market is selling at 4.5 and I'm buying it at a 6, maybe I'm getting a good deal. Maybe the price I'm paying is actually a better bang for the buck based on the income that the property is currently generating. So that's why it's a big thing. And to answer Jeff's question, on the back end, it ultimately determines your sale price. So having the right terminal cap rate, what'll happen is you're going to take that cap rate and it's going to be divided by the NOI to come up with your purchase price. So the lower the cap rate, the higher the price. The higher the cap rate, the lower the price. So they have an inverse relationship, but it'll be very important to your underwriting.
Totally agree. And yeah, so sorry, Charles, you were going on the cap rate, and you were gonna say a few more things about that.
Yeah, so there's a few other things that I think are important also. Another one is income and expense escalations. There's two types of rent growth you're gonna have. One is gonna be a value add bump. The value add is typically if you're buying a deal that has some type of physical or operational component that's gonna allow you to increase the rents. Typically, the bulk of the value add is probably within the first 1 to 3 years, depending on how big of a plan it is. And the second one is just your annual escalations, which is like organic living increases. So for anybody who's been following the last couple of years, many markets, and when I say last couple of years, I mean even last 8 to 10, many markets throughout the country have had higher than historical norms for rent growth. And you can make an argument maybe those will continue. Now, specifically from 2020 to 2022, most markets had, I'm not even going to call it high, I'm going to call it insane rent growth. Much of that is not sustainable and it's largely related to an expanding currency supply that we've had, but it's probably not something we're going to see continue. So what I would tell anybody is to look at what historical norms are for the markets you're investing in. Speak with brokers, speak with property managers, speak with people that know the markets, and underwrite to those historical norms, because those are more likely to be what you see going forward, unless we have some type of black swan event like a pandemic again. So that's always important to make sure you're using reasonable assumptions in your financial modeling and your underwriting. And then aside from that, probably the debt assumptions you have. So that's going to be a big thing. The deals that, recently, like we've been buying some deals that have great loan assumptions. And that's the reason those deals work. If we went out there and we tried to place new debt on them, we'd have to pay a substantially lower price because there's no way those deals would work at those numbers. So having those things ironed out will really allow you to be solid with the underwriting and to feel confident that you're making a good decision.
Yes. And you nailed it on some bigger things, like you said, rental growth. I know a lot of people, we all know a big guy named Grant Cardone, right? He projecting 10% rental growth year over year on all his assets. So we actually seen his underwriting. We couldn't believe it, right? Because like you said, it's historical highs of rental growth. That's not really what's going to happen going forward, right? With the market being the way it is. So just for us to get an idea, when you guys are underwriting deals, are you doing any rental growth? I listened to a podcast today where there's a guy named Rice 48, who's a big operator out in Dallas. I think you guys had him when you guys had the event at Cash Flow Champs. You guys had the webinars. He was there. He was saying they're underwriting with no rental growth for the first year, and then going forward after that, I think they're doing like 2% rental growth. Do you think that's a more conservative approach, or is that something that you guys are looking, or just kind of?
I do. So we are underwriting for a value add bump, even in years 1 and 2, if we expect that there's one to be achieved. But in terms of annual escalations, we're using 0 for years 1 and 2 at this point, and then 3% from year 3 on in most markets. So I do believe rents are going to flatten out. In some cases, they might drop. There was a tremendous amount of rent growth from 2020 to 2022. And what that resulted in is in most markets in America, you probably had the equivalent of a decade's worth of rent growth in 2 years.
Wow.
So,
yeah.
And you have a lot of people whose wages didn't keep up with that, even in spite of the tremendous wage growth we've had. So because of that, you're seeing an imbalance and things are resetting a bit, so that way people can have their wages catch up with what's happening on the rental side.
And would you say that's correlated to the market that you're in as well? Like it depends a lot.
So the market that we've been having the most success in recently is the Atlanta market, and depending on the reports you look at, Atlanta and Phoenix are probably the 2 markets with the highest rent growth from 2020 to 2022. So Atlanta is definitely going to have some of that because it had such tremendous growth in such a short period of time.
But so just for the listeners to know, so you're not necessarily, you are projecting that it's going to go up, the rents are going to go up over the life of the project, but
Yes.
you're just catching up to what the current market rent, rather than projecting it's going to keep growing the first year, for instance, right?
Correct. Yep.
Okay. Well, that's awesome. And Charles, just kind of switch topics here a little bit. Tell us a little bit about Cash Flow Champs. So tell us a little bit about why you've decided to kind of put this all these big operators together to form Cash Flow Champs. Tell us a little bit about what it's all about, and what are some of the differences between Cash Flow Champs and some of the other groups out there.
Yeah, totally. So, for me personally, I was involved in a prior partnership, and thankfully we left on good terms. We even still do some deals together. But what I realized is I wanted partners who were looking to do more deals and do bigger deals. And that was kind of how Cash Flow Champs started, because I worked with two of the guys in there before on different deals on a deal by deal basis. And we figured, okay, let's align so that way we can come together and just figure out how to scale this. So we probably have a bigger team compared to most. We have 6 partners, which certainly leads to a lot more, pieces of the pie being divided up and things like that. But I also figured it could allow us to scale faster, and that was the real benefit behind it. So we all play different roles, and we aim to play roles that suit our skill sets, so that way we have everybody working in the right spot for maximum efficiency.
Awesome. And I just wanted to add to that. So I know we talked about your first deal. Now tell the listeners from that, was it a 90 unit or 100 unit? What are some of the most recent deals that you're currently whether closed or that are working on? Just for the listeners to get an idea.
Totally. So the most recent one was a 236 unit deal, and for me personally, that's the biggest one that I've been in so far. So a lot of times what happens if you stay around long enough is that doors start to open up for you. So the way I describe it is, every time you close a deal, think of it like playing a video game, in the sense that you're leveling up and you're getting access to something that you haven't had access to before. So the first deal was a 92 unit deal, and that at least gave us something to put on the track record. So it gave us some credibility, and people who wouldn't have taken you seriously before at least start to say, okay, these guys closed the deal, they have something on their track record, so they take you a little more seriously. They start thinking, okay, maybe these guys are legit. The second deal we did totally was not what I wanted to do. It was the smallest deal I'd done, 48 units. But why did I do it? Well, one, the deal itself worked really good. Out of all the deals that I've ever underwritten, it's probably the best cash flowing deal I've ever seen. So more of the returns actually on the cash flow side than what we expect to have on the backside. So that's very, very promising, which is great. And also, what I knew it would do is open doors. So the broker that sold it to us wound up becoming my best broker relationship. And what that did is it opened doors. And that was my thought process when I did the deal. I said, okay, if we can do this and we can close this deal, maybe it'll open up the floodgates a little bit, so it'll start trusting us with bigger stuff. And ultimately, with the 10 deals that I've done, that broker was involved in 4 of them, and there'll probably be more in the future as well. But the second deal I did with him was 130 units. The next one, eventually wound up being similar size, and then the largest one was 137 units. So, sometimes you need to use things as a stepping stone. And while that wasn't necessarily the deal I wanted to be doing, what I realized is, okay, it's better to be doing a deal than not doing any. And then eventually build the track record. Yes.
Absolutely. No, I think relationship building is extremely important. And I like the analogy that you put out there that, it's kind of like a video game. Once you start breaking levels, you can start leveling up and doors start to open. So I really like that you're able to explain that from that perspective. Charles, I wanted to ask, due diligence is paramount in any real estate investment, but what steps do you take to conduct a thorough due diligence on multifamily, and how do you mitigate risk?
Good question. I don't know that there's ever an exact science to it, but you want to take as much precaution as you can. So what I would say is, anytime you're playing a game as expensive as multifamily or commercial real estate, there's always going to be some level of risk. But on the front end, what you want to do with the diligence is you want to do really three things. You want to do physical, financial, and legal. On the physical side, you're doing a full inspection of the property, so you're walking 100% of the units, you're looking at all the common areas, and not only are you doing it, but you're also having somebody else there who's with you. We usually bring our property management company. They have a maintenance team they bring with them. And a lot of times they're getting 30 to 40 vendors out there over the course of the inspection. So that way, aside from just us and our management company, we're also getting professionals who are licensed in whatever trade it might be. And we're getting different opinions so we can see what their perspectives are. Now, even with that, are there things that you're unaware of? Yes, believe it or not, you can do that thorough an inspection and still have things that you find up not knowing. That happens. But the key is that you want to identify at least any major red flags that could potentially be very costly, or that can give you a lot of grief later on. On the financial side, you're looking at previous year's financials. Most times you want at least 2 to 3 years of previous year financials. But obviously, if the sellers own the property less than that, you may not always get that, but you want to aim for it. And you want to do a full lease audit. So you're going to be taking the rent roll and comparing it to each of the individual lease files and see if the information matches up, and make sure that you're buying the property that you expected to buy. The last thing you want to do is find out that you bought a property and the numbers that the seller gave you were all wrong because you didn't do your homework on it. So you want to do the best you can to confirm that the information they're providing you is legit, and that there's a high probability of those numbers actually continuing once you buy the property. Then the legal side, there's going to be different items on the checklist. Most times with those items, I usually leave those to our attorney. I try to stay as far out of those as possible. But you'll have things on the title and the deeds and things like that. Any encumbrances that you have on the property and any different types of liens. So things that you want to have your attorney and your legal counsel research to make sure you're buying a clean and marketable title for the property.
Wow, those are some golden nuggets right there. I hope you guys are taking some notes like I am here, because that was some golden nuggets right there that Charles was able to share with us. Now, Charles, for the listeners that may not know, I know you mentioned the Atlanta market. What are some of the other markets that you and the Cashflow Chimps are currently seeking opportunities in, and why?
Yeah, totally. So for us, our primary markets are really the Southeast. We focus in the Carolinas, Georgia, and Florida. Those are our main markets. We will occasionally look at some other deals in different parts of the Southeast and the Midwest, but that's really our main stopping ground that we focus on.
And then why those markets?
Well, in part because of the growth in them. 4 years ago, I moved to Charlotte because at that point, it was a market that I knew we wanted to focus on, and we saw a lot of people transitioning down here. So I said, let me just put myself in the center of it and work on building connections. But over the last decade plus, all of these states have seen tremendous growth. There've been a lot of population trends that show people moving down there and continuing to move down there. And part of the reason is that you've seen a lot of jobs come this way. So many of these markets in these states have been very business friendly, and because of that, they've attracted employers. A lot of the companies that are tired of the conditions in places like New York, which I'm from New York. But people are tired of that and they're looking for more business-friendly environments. So they said, let's come down to the South. And what's happened is people have migrated there to follow the jobs. Many of them also go for the weather patterns. They like the warmer weather versus the colder weather, and then just some of the income tax benefits. So all those things coupled together have led to a lot of growth in the Southeast and the Sunbelt region as a whole.
Absolutely. And I couldn't agree with you more. And essentially, a lot of our listeners, Charles, like you may know, they're Canadian investors. They want to get into the game, they want to invest, but they just don't know enough about investing in the U.S. Why the Sunbelt region? And so we wanted to kind of get your perspective and share those topics. So now, Charles, as passive investors seek opportunities, what advice do you have for those considering investing in multifamily properties, specifically in U.S. multifamily properties? Like, what are some essential factors they should consider before diving into this asset class? Any questions they should ask their sponsors, and so on?
Yeah, good question. So the first thing is, for people themselves, I think it's important to be in a position, one, where you're in the right mindset to be able to perform optimally. You want to make sure that on your own personal plate, you have your own life in order and your own things going in the right direction so you can devote the time and the energy needed to be successful. And ideally, that you have at least a couple of funds that, even if you don't invest in deals, you may need them just to carry deals or to do different things. You want to figure out also where your own skill sets and strengths are, and know yourself so that you can work on finding the right partners. There's really three things that this business comes down to. It's finding deals, finding money, and running deals. So those are the three main roles that you have. And the object is you want to figure out which of those roles you fit best in, and then put the people around you that fill the other roles so you have a winning team. And sometimes that may not happen the first time out. You may need to go through a couple iterations and figure out what the right team is. So don't be afraid to make mistakes. Realize you're probably going to make mistakes, and just be quick to learn from them and to correct them, so that way you can try something different the next time out. With any business, whether it's multifamily or just anything, I would say probably the most important characteristic is resilience, and being able to, to be able to get back up after you get knocked down. It's rare that you see success stories that shoot straight to the top. Most of them have some type of bump along the way, or many bumps along the way, and you need to be able to get back up after you stumble over those bumps.
Wow. That's that you heard it here first by Charles Seaman. And no, I couldn't agree with you more. And even as when we were starting our real estate investing journey, like some of the biggest hurdles we faced was how do we get funds into the state, educating people, and that's part of the reason why we created this podcast and the webinars that we do, to be able to really educate folks on what is multifamily, why we like the US over Canada, and much more. So I couldn't agree with you more. John, anything to add?
Yeah, we're just here towards the end, Charles. We have really enjoyed getting to know you and your experience, and you have an art in underwriting, and just kind of getting to know your underwriting process and so on and so forth. But I wanted to ask you, how do you stay up to date on the industry trends and best practices when you're enhancing your underwriting skills?
Good question. For me personally, what I like to do, I do subscribe to a lot of different market data, but admittedly, there's only so much time in the day, so you can't really I actually find that a lot of the big brokerages do have some really good market data, so I do occasionally glance at some of that. But truthfully, it's just from staying active in the market and speaking to people. And I think the best resource you can get many times is speaking to people that are on the ground in the markets you're in, and speaking to them regularly, so that way you understand where conditions are at that time and how they're changing.
Wow.
Absolutely.
Keep in mind, any data, there's always going to be a lag in it. So speaking with people is going to give you real-time information, which will be a lot more timely than waiting for something to be updated on a data service.
And when you say speaking to people, Charles, are you referring to investors, like property managers, appraisals, lenders, everything and more?
Yeah, absolutely. So brokers and property managers, for sure, those are probably my top two resources. But lenders and mortgage brokers are great resources. Definitely appraisers also. Interestingly enough, what you'll find is a lot of appraisers don't truly know how to appraise commercial real estate. Many of them rely on the brokers and some of the other professionals anyway. But they can all be good resources to utilize.
Awesome.
Absolutely.
And Charles, just wanted to ask you, that's kind of where, like John said, we're wrapping up here. Wanted to ask you, obviously we know very well, but for the audience that may not know, what would you say your superpower is in the multifamily? I think you probably have a number of things that you're good at, but we wanted to...
Yeah, we know you're a jack of all trades, but if you can just narrow it down, Charles, that would be amazing.
Well, thank you. I think you're probably being too kind, but it's probably going to surprise you, because most people think underwriting, because that's what I'm really known for anybody who doesn't know me. But I would actually say it's dealing with people. And I think with any business, but especially a business like this, it's very much a people business. And you have to figure out how to deal with people effectively. And whether you're an introvert, whether you're an extrovert, everybody's going to have their own style and their own approach, and there's nothing wrong with that. But you have to figure out how to do it, and ultimately how to manage people. So that's going to be big. But a lot of the best results that I get are by talking to people. The reason that I win most of the deals I do is because I talk to people. So it's speaking with people, it's building relationships, and it's figuring out how to leverage those relationships so that they can become mutually beneficial for both parties.
Wow, that's golden because, like you said, it is a people's sport. It is a people's industry, and multifamily, definitely it's people's skills. So I have no doubt in my mind that you and the cash flow teams are gonna go beyond the expectations. So looking forward to that. Awesome.
Thank you.
So as John, anything you want to add or?
No, I mean, I think we've covered it all. We're going to move on to some fun questions here as we try to keep it entertaining here for everybody towards the end. We asked some pretty fun and crazy questions, Charles. So if you're ready for these questions, here they go.
Yep.
If you were a host in a real estate themed reality TV show, what would it be called and what would be the premises?
Good question. Well, if Robert Kiyosaki wouldn't sue me, it would probably be something like How to Escape the Rat Race. I've always liked that concept. Admittedly, I'm a big Kiyosaki fan, and I think real estate's a great tool to use to do that. And maybe the concept would be almost taking the cash flow game and putting it in some type of reality setting where you have to create passive income through multifamily or through real estate, and being able to figure out who's able to do that most effectively during the show.
I like that.
Wow, that's different.
I haven't heard that one before. That's awesome. Okay. And let's see what we have here. And then if you could invest in real estate anywhere in the world without any limitations, where would it be and why?
Good question. Well, right now, I guess it would have to be the southeastern U.S. I mean, part of me said, if you say without any limitations, maybe I'd pick New York because that's my home. But then I look at some of the policies and the laws, I'm not as favorable on those. So probably the Southeast, I think it's a great spot to be. And I would say as market conditions change, I think buy as much as you can and just ride the cycle up so you can make as much money as possible with it.
Love it.
Amazing. And go ahead, Jeff. Go ahead.
No, I was going to say, just for people to know, like, obviously you are currently very active in the market, even with what's going on, even with the interest rates. Because some people might be on the sidelines right now thinking, oh, I'll wait until interest rates go down, or I'll wait until the market slows down a little bit. Do you have any recommendations for those people that are sitting on the sidelines, they're not really sure what to do?
Yes. First thing I would tell you right now is be patient. Right now is not the time to get aggressive. There's three types of deals to me that are going to have potential this year. The first are deals with attractive loan assumptions, which are actually the ones that we've been having the most success with so far. The second are deals with some type of creative finance, maybe a seller finance, maybe a subject to. A lot of the strategies that people use in single family very effectively. Mm-hmm. And, do I think you'll see that on a 200 unit apartment complex? In most cases, probably not. But could you see it on a 30, 40, or 50 unit apartment complex? Absolutely. Most of those you're dealing with mom and pop owners, very similar to what you would buy a single family property from. So, using some type of creativity may allow you to close the gap between where sellers want to be and where buyers are, so that way you can figure out a win-win side for both. And the third one is distressed properties where owners just don't have any choice and they're selling it for pennies on the dollar. In my opinion, obviously there's a lot of different opinions out there, I think in the next 6 to 12 months you will see a lot of those opportunities.
Yes, I couldn't agree more. It's you got to be ready to capitalize on that opportunity, and no, that's you nailed it right on. Go ahead, John.
Absolutely. Charles, thank you for sharing your incredible insights and experience in the multifamily investments with us today here. Your track record and expertise are truly impressive. Jeff?
Absolutely, Charles. Your journey is inspiring, and we are grateful for the knowledge that you've shared with our audience. I know you're in Charlotte. We're looking to be in Charlotte, so I cannot wait to see how we can collaborate and we can do some big things. I absolutely love. I'm going to be down there in a few weeks, so I'll definitely reach out to you, see if we can connect in person. But thank you so much, Charles, for being here. Thank you for taking the time. Now, go ahead, John.
Yeah, for any listeners that want to connect with Cashflow Champs, Charles, what is the best way for them to get in contact with you or Cashflow Champs?
Yeah, totally. So what I'll do in the chat box, I'll put a link tree, and the link tree will have all the different social media links and all the different ways to reach me.
Perfect. And yeah, we'll make sure to attach that to the show notes to make sure that folks can connect with you and learn a little bit more about you guys. Do you still host the underwriting every on the Saturday?
Yes, every Saturday, 4 p.m. Eastern.
Okay, perfect. Yeah, so I just wanted to share that with folks that you do have an underwriting. That's actually how we learn underwriting ourselves. It was very, very helpful, and you go through in depth how to underwrite. So we'll definitely make sure to attach that as well. But again, Charles, thank you so much for coming into our podcast today and sharing some really big golden nuggets that I'm sure that the listeners will get tremendous value for. So again, thank you again, Charles. Stay tuned for more enriched episodes as we continue to bring exceptional guests like Charles and bring valuable insights on passive investment in US multifamily. Don't forget to follow us on social media for updates and exclusive content, as we also do host monthly meetups and monthly webinars. Thank you so much, Charles.
Great. Thanks for having me, guys.
Thank you, Charles.
Thank you.